Good afternoon. Good afternoon. I am Kathy Neifeld, one of the principals at Agency One. On behalf of my partners and our amazing Agency One team, I am thrilled to welcome everyone to our bi-weekly webinar series. This is the 12th webinar that we have hosted this year, and all of the webinars, with the exception of one, have been recorded and can be found on either the Agency One website or on our YouTube channel. If you are looking for information on asset protection and estate, income, and gift tax planning, bear with me one second because my screen just morphed. I don't know what just happened. Sorry about that. If you're looking for information on asset protection and estate, income, and gift tax planning under President Biden's administration, digital marketing tools, strategies, and resources that you should be using to help drive more business, a premium financing update, underwriting information, a current economic update, information on whole life carriers and opportunities in the whole life marketplace, life insurance strategies to capitalize on opportunities in the small business marketplace, information on Proformex and in-force policy monitoring system, information on product changes, price increases, and specific conversion opportunities from various carriers, or perhaps are interested in an industry perspective from the president and CEO of John Hancock Life Insurance Company, I encourage you to access these webinars. The speakers are nationally recognized and renowned industry experts, including estate planning attorney Alan Brown, advanced markets consultant Randy Zipsey, digital marketing expert Samantha Russell, the Senior Vice President and National Director for Premium Financing at U.S. Bank, Taylor Miller, economist Anirban Basu, Brooks Tingle, the President and CEO of John Hancock Life Insurance Company, our very own superstar underwriting team, led by my partner, Dennis Bartos, our very own head of case design and illustrations, Ed Stark, and many others. For those of you that are new to Agency One, a brief introduction. We are a very high-touch, exclusive BGA. Exclusive, what does that mean? We have a platform called the Agency One 100, and one of our guiding principles is to work with a small, select group of advisors in a very large way. The advisors that are part of this group are like-minded, highly successful, creative, and driven. We focus on life insurance and fixed annuities. If you have other needs like disability or life settlements or standalone long-term care, we have strategic relationships with the best providers in the industry to refer you to. We truly have the premier underwriting department in the industry, led by my partner, Dennis Bartos, and advanced markets and case design departments, led by my partner, Gonzalo Garcia. If you want high touch, personalized attention, advocacy, and want to feel like you and your cases are important, then Agency One is or should be your BGA. If you would like to learn more about us, the Agency One 100 platform, and how you can become a part of it, or if you have a case you would like to discuss, please reach out to us. I have an additional important announcement about what Agency One has planned for next month, and I will be sharing this with you at the end of the webinar. Now on to today's webinar. The Secure Act, IRA Max, Financial Planning Opportunities, and Case Studies. Boy, that's a lot to cover in 1 hour. So let me get right to the part where I introduce our three speakers for today. They include Carly Brooks, AVP and Counsel, and the head of the Advanced Markets Group for the U.S. Individual Life Operations of John Hancock. Carly manages the Advanced Markets team and helps drive strategic growth initiatives by providing case consultation, technical expertise, and marketing support to producers and financial professionals in the areas of estate, tax, and business planning. Joining Carly from John Hancock is Joseph Sienna. Joe is the Director of Advanced Markets for the U.S. Individual Life Operations of John Hancock. And among other things, in this capacity, Joe provides consultative, and case design services for producers and field personnel. And we are also delighted that Agency 100 advisor Kim Nadovitz agreed to share her experiences and participate in this presentation. Kim is a member of the Individual Solutions team at TriBridge Partners. She has 20+ years experience in the insurance industry. During this time, she has focused on collaborating with high net worth individuals and their advisors to develop customized insurance solutions and has a particular interest in planning for long-term care. She has been recognized by Bethesda Magazine, Washingtonian Magazine, and Northern Virginia Magazine as a go-to insurance advisor. I would also like to introduce Wayne Baldwin, Agency One's Regional Vice President from John Hancock. I'm not sure we're going to be able to see Wayne on screen, but Wayne has been working for John Hancock and Manulife for 49 years. He provides phenomenal assistance and support to Agency One and our advisors, and was instrumental in helping put this webinar together. The speakers will try to respond to any questions that have been asked at the end of the presentation, so please submit your questions through the question or chat feature at the bottom of the screen, and we will be monitoring them as they are submitted. This session is being recorded. I will now turn the screen over to Carly. Carly, take it away.
Great. Thank you so much, Kathy, for the introduction and to Agency One and for inviting us to speak on your call today. Thank you for everyone that has joined and taken the time out of your afternoon to meet with us. This is a really important topic, and I'm hoping that today, as we talk about the Secure Act and what that means a little over a year after the enactment, you'll be thinking about sort of the clients that you work with, and we'll hopefully walk through a couple of different applications of retirement planning with life insurance and why we feel that's particularly timely. But I'll kick it off by just giving an overview of what was the Secure Act. At this point, it's was signed into law at the end of 2019. So you may have some familiarity, general familiarity with what the Secure Act is and what it isn't. But how does it apply to what we all do, and where are the opportunities is, again, really what we want to focus on today. So just some background on the Secure Act. Like I said, this was signed into law back at the end of 2019. So we've now been under the new rules for a little over a year and a half. This was that rare piece of legislation that actually had huge bipartisan support. So it was really the biggest overhaul that we'd seen to the retirement planning landscape since the Pension Protection Act back in 2006. And what the Secure Act did, so most of the provisions within the Secure Act impacted IRAs and defined contribution plans like 401ks. This was really intended to be, a lot of good public policy within the Secure Act, helping people to save for retirement more effectively. But ultimately, the Secure Act was a revenue-raising provision. So the Secure Act was projected to generate $15.7 billion just from limiting the stretch IRA. And the stretch IRA is really where there's been a lot of buzz around the impact of the Secure Act in the high net worth space. And so that's what we'll spend most of our time talking about today is what does the impact of the loss of the stretch mean for your clients, and what are some ways that we can offer flexible solutions to help replace that loss of the stretch. Oops. So looking at the summary of just kind of high level key changes, what happened within the Secure Act. One of the big changes were changes to the Rmd rules. So the required minimum distribution rules under the Secure Act are now age 72 is when you have to start taking RMDs. So under the old law, you would have to start taking RMDs at 70 and a half. Today, that's been extended to 72. One thing that I find to be interesting related to contributions is that now people who are still working can still contribute to their IRA. So you can contribute to an IRA or qualified plan after age 70 and a half, but you still have to start taking RMDs at that time. So if you're a worker who's say 75, you can still absolutely contribute to your IRA, but you still have to be taking distributions at that time. There were some other provisions within the Secure Act too that were interesting. So expansions to 529 plan rules. There was a lifetime limit of $10,000 for student loan repayments from 529s that was added. There, we saw some ability to take distributions for births or adoption. So again, a lot of good public policy. But the death of the stretch IRA or the changes to these inherited IRA rules really was sort of the featured provision that we saw, and that really generated a lot of questions and in some cases concerns for our clients. So when we're talking about these inherited IRA rules, the old law was what we would call a lifetime stretch. So basically what that meant was if you had a beneficiary of an IRA or defined contribution plan that was a designated beneficiary. So what I mean by that is someone who's a named individual. So think, your daughter, or it could also be a qualifying see-through trust. Under the old law, you'd be able to stretch distributions over the life expectancy of that designated beneficiary. If the beneficiary wasn't a designated beneficiary, such as the estate of the participant or a trust that's not a see-through trust, then typically at death, if death occurred before the required beginning date, distribution would occur within 5 years after the participant's death. Or if it occurred after the required beginning date, you'd have the participant's remaining life expectancy to take distributions. Under the law today, now in most cases, the IRA has to be distributed within a 10-year period of the participant dying. So basically that curtails the ability to stretch the IRA over the lifetime of the beneficiary. So looking at these rules, again, this is going to apply to what we call designated beneficiaries. So so a designated beneficiary, again, think about a child or could it be a grandchild? You're going to have the entire account distributed on December 31st of the 10th anniversary of the participant's death. Something interesting here, this was actually a bit of a win. So back when the Secure Act was being negotiated, it was initially going to be a 5-year payout and totally eliminate the stretch with the 5-year payout. We did end up getting this 10-year payout, and there are some exception distributions for certain classes of beneficiaries, which I'll talk about in a second. But there was some compromise there, but I think, again, it still is concerning where you no longer have the ability to stretch over the lifetime of the beneficiary. So, you could potentially, one other nuance here too, is that you could actually potentially end up with a longer payout period if the person who dies within payout, the person who inherits it also will get the 10 years on top of that. So you could get a slightly longer period. So say if you're 3 years into receiving payments and then you die, then you could potentially get a few more years. But generally speaking, it's going to be a 10-year rule unless you fall within one of the categories of eligible designated beneficiaries. So these typically are going to be surviving spouse is kind of the big one here. Minor children as well. There's some limited exceptions within that. Disabled, chronically ill, and then the one that's sort of a nuance is, I guess, a beneficiary that's 10 years younger than the participant, or less than 10 years younger than the participant, excuse me. So think about, I guess, if you were to leave that to, I don't know, maybe it's a sibling that you leave it your IRA to, where your sibling is the beneficiary of your IRA, they would have their life expectancy to stretch the IRA. So those are really the only carve outs to the 10-year rule. We operate under the assumption in most of the cases that we talk about that we are playing under these limitations within the 10-year rule. So looking at the impact from the loss of the stretch, what does this mean for our clients? Well, I like this example because if you take a $2 million stretch IRA that was inherited by a 40-year-old at 5-year-old growth, under the old law, which is the column on the left, we can see that under the prior law, you could stretch the IRA over the life expectancy of that beneficiary. So maybe it was a child, a grandchild, great-grandchild. In some cases, depending on who that beneficiary was, that would yield decades of tax deferral for the funds in the IRA. And as you can see from this example, when you have that $2 million IRA inherited by a 40-year-old growing at 5%, that would mean distributions between $45,000 to $70,000 in those first 10 years based on the 40-year-old's life expectancy. So that means at the end of year 10, you still have $2.25 million in that tax advantaged account. So there's really substantial amount in the account still at the end of the 10-year period. Now today, post Secure Act, distribution of the tax deferred accounts is rapidly accelerated. So obviously you have until December 31st of that 10th year to take the distributions, but that's going to trigger income tax for designated beneficiaries much sooner. Under the stretch, you're not going to get that same tax deferral. There's a couple options there, so they could take it as a lump sum. In this example, we're showing distributions over the 10-year period. So we're assuming that the beneficiary takes distributions between $200,000 and $310,000 a year in distributions. That, like I said, is going to bump the beneficiary to a higher tax bracket. But alternatively, they could take it all in year 10. No matter what happens, though, either way, they want to actually do this in practice, they're going to lose the ability to get that deferral. And there's going to be some issues with managing income taxes in a lot of these cases as well. Realizing funds more quick, receiving funds more quickly than anticipated. This can also frustrate planning goals. So we see that sometimes where you have a client who may have children or grandchildren where they don't feel like they want that beneficiary to receive that money upfront. Maybe they have spendthrift issues, or maybe they have other reasons why they don't feel like they want them to have that on an accelerated basis. So in those cases, the loss of the stretch can have both tax and non-tax consequences for the clients. So what can we do about this? Well, this is really what the meat of the rest of our discussion is today, is looking at this idea of taking an IRA or a qualified plan and reframing the conversation in light of the Secure Act. So, the way that I position this and think about it is IRAs and qualified plans are excellent retirement vehicles. They were never intended to be legacy vehicles. They've always been intended to be retirement vehicles. And that, I think, is common sense, but the new law reflects that. So if you have a client who has an IRA that's not needed for retirement purposes, so if they're saying, I'm excited about the increase in age to 72 for RMDs, I don't need the money, I'm going to reinvest it just reinvest the money, I'm not going to spend it. That by definition becomes a legacy asset. And so whenever we have a legacy asset, where Joe and I sit is we're always looking to see, can we optimize on that asset? Is there anything that we can do to enhance that asset as a legacy vehicle for the next generation? So the story behind IRA maximization discussions is kind of the same. So we're looking at taking distributions from an IRA and using that money to purchase a life insurance policy. But the conversations that we've been having and the uses in light of the Secure Act have changed somewhat. So we're looking at, could we optimize the IRA so that the net to heirs is increased at life expectancy? And then beyond that, how does the life insurance policy help with holistic retirement planning goals? And we're gonna walk through two case studies today. And you'll see that depending on the size of the IRA, there are different options for different client profiles. But before we get into the case studies, and I'll turn it over to Joe in just a minute, he's going to show again how to deploy those funds from the IRA. I just want to spend a minute to go over the various ways that life insurance can help to meet these different planning objectives. So a lot of flexibility is really the key takeaway to this slide. But in the first example, increased tax liabilities, I talked about this a little on one of the prior slides, but if you have a situation where you have a child who's inheriting an IRA in peak earning years, that 10-year period, or again, the lump sum, is that going to put them in a higher tax bracket for both federal and possibly state estate taxes? So pre-Secure Act, again, assume, when mom dies, daughter gets the IRA. She can take distributions over her whole lifetime, so you can manage that impact of income taxes more efficiently. Post-Secure Act, maybe now she's going to be in peak earning years, or if she's not in her peak earning years, taking distributions from the qualified plan might push her into that. Similar thing with an accumulation type trust. So an accumulation trust is a type of trust that allows for RMDs to remain inside of the trust, with the trustee having discretionary distributions to beneficiaries. So under the new law, you're required to distribute the trust within the 10-year period as well. So what that means for trusts, which are taxed at compressed income tax brackets, that means accelerated income tax payments at higher rates that are charged to trusts. So it's a similar analysis in both cases, whether you're talking about trust or not. But in both cases, having a life insurance death benefit could help to provide liquidity to help cover those increased tax obligations. Secondly, repositioning assets. So could the insurance proceeds help to provide flexibility for a variety of needs? So it could help to delay RMDs. So that would be a situation where maybe the surviving spouse is older and maybe does need to have that money for retirement needs. You could use that to offset that. Converting to Roths, that sometimes comes up. So could you use the life insurance proceeds to help pay the taxes on a Roth conversion? Good amount of flexibility there as well. And then the big one that we do spend some time talking about is this idea of mimicking the stretch that we've now lost post-Secure Act, where you could potentially leave the IRA and redirect unneeded RMDs during life to buy life insurance with the death benefit going to a trust for, it could be for children or it could be for grandchildren. So one example that we've seen is you could leave the life insurance policy to a GST trust for grandchildren and leave the IRA to the children. So the children, they're being kind of made whole in that sense. And then the life insurance policies in this GST trust that can be used for generations for the grandchildren with, depending on what the trust provisions are. So you have the tax-free death benefit to the trust, and that can mimic the stretch with discretionary distributions going to the beneficiaries. A similar type solution could be for charitable remainder trusts. So you could leave the IRA to a CRT, and that basically simulates a stretch, and then take the life insurance as wealth replacement to replace the interest that's going to charity, so wealth replacement for other beneficiaries. So really the messaging here, there's a lot of different ways we can discuss this depending on what the client's planning goals are and what's important to them. But the message here is that the insurance will just give the clients a lot of flexibility to direct how life insurance proceeds are used. Otherwise, you're going to let the IRS decide that for you. Before I turn it over to Joe, a couple really quick rules for this year just to be aware of. So last year, due to COVID, the CARES Act, there were special rules for 2020 only, including that RMDs were waived. That was just for 2020. So for 2021, RMDs are back. We'll have new life expectancy tables to calculate RMDs starting in 2021. But we're basically calculating RMDs this year as if the 2020 waiver had never occurred. So there's no makeup 2020 RMDs for this year. And if there's questions about that, you can reach out. We can talk about that. But another thing to just be aware of is the age for an IRA. So you could run into a situation where you have an IRA owner turning 72 this year. That's going to have an RMD due this year, but the due date will depend on when they turned 72. So there's some little nuances there planning wise that can be helpful for your clients. Then last but not least, you may have heard some buzz or seen some things in the news about this Secure Act 2.0. What is that? It really is what it sounds like. So it's sort of the second arm of the Secure Act. They're calling it the Secure Act 2.0 as the nickname, but this is just legislation that's aimed to encourage Americans to save more for retirement. They're trying to make that process easier. It is widely expected that the bill will pass this year or early next year. It has wide bipartisan support, similar to the first Secure Act did. There's not a whole lot in there that I think would be really relevant for our clients. But one thing just to be aware of is that the date to take RMDs could potentially be delayed to age 75. That's phased in over a 10-year period. So the 75 RMD age would not be until 2032. But just a few things in there to be aware of. We'll keep an eye on that. We monitor legislative updates very closely within advanced markets. So certainly as that progresses, expect to see some things from us. But at this point, I'm going to turn it over to Joe and to Kim, and they're going to walk through some case studies that we worked on.
Thanks, Carly. I've had the pleasure of working with Agency One for many, many years. Gonzalo and his staff are just excellent partners. I had the pleasure of working with Kim on a case recently. And Kim, maybe you want to just give a little background of how we got together?
Sure. So earlier this spring, Agency One had a webinar where they introduced some concepts with regard to taking required minimum distributions and using those to purchase life insurance, especially where clients were going to have an IRA that would be subject to not only income tax, but estate tax as well. And so Gonzalo and Kathy kind of previewed this analysis. And in doing some client reviews, I began to run across some clients who had some very large IRA balances, some inherited IRA balances. And when I questioned them about what they were using the RMDs for, a couple of them said, well, we're just reinvesting, or we pay taxes and so on from there. So that's when I approached Gonzalo and Kathy about how do we demonstrate what it would look like for this client if they were to use these distributions to buy life insurance, and sort of determine what would be the positive outcome to the family from there. So in this particular case, this client, in addition to having the $6 million of inherited IRA, had a Roth IRA and a substantial amount of assets that it was easy to see that they were going to have a taxable estate, and that this IRA would be subject to substantial, shrinkage from there. And that's when, Joe, Gonzalo, and I really started putting together these numbers and looking at these different options, and made a presentation to the client's wealth manager and CPA, who also liked the idea of really looking at the life insurance as opposed to just reinvesting the RMDs, because it was a better outcome for the client. But they also like the fact that the life insurance essentially was another asset class that wouldn't correlate with the other assets in the client's portfolio. And I really have to give all of the credit to Gonzalo and Joe, because quite frankly, they really did all of the heavy lifting. I attended the webinar and identified some clients to speak with, but the support that I've received in terms of really being able to, illustrate what this looks like is not something I ever would have undertaken on my own. And quite frankly, now it's something that I really talk about with almost every advisor that I have an opportunity to speak with. So I was just doing a review meeting with a CPA for his life insurance. And I said, do you have a few minutes? Can I share with you a little bit of the analysis that we're doing for some of our clients who have IRAs and don't necessarily need the income from there? So, and the clients that we've been working with have been anywhere from their early 70s to some clients who are under the age of 65.
This particular case has kind of helped you open up some new opportunities, and it was really interesting to work with you on this case, because it wasn't the basic Q Plan Max case, as we like to call it. What you're seeing on the screen is a piece of our client-facing presentation that we customize, in this case for Kim's particular client. And we break it up into two basic pieces. One is showing the advantages of using life insurance as a leverage device. And as you can see, we show the current plan with the when at age 91, or life expectancy of Kim's client, where the numbers would fall under the current plan and under a proposed plan. So if they just held on to the IRA and reinvested the RMDs, the children, who would then be age 66, would net about $5.2 million. By acquiring a $4.5 million life insurance and basically reinvesting those RMDs into the life insurance contract, you're basically increasing the potential net to the heirs by over $2 million. Now, that's Q Plan Max. And behind this summary are all the spreadsheets that have all the numbers that show the RMDs and what have you. But basically what we're showing here is the advantage of using life insurance as a leverage device. So at this point, really, it's up to the client to decide, well, yeah, the life insurance makes a lot of sense, but how do I deploy these two buckets that I've created as a result of buying this policy? How do I distribute them to my family? And that's always obviously an individual choice. On the next slide, we show two options, and this is something that Carly alluded to earlier. Given where we are with the limitations within the Secure Act, one thing that can happen is just leaving the IRA, which would have had a value of about $3 million to the children, and have them take that in installments over a period of years. Now, we could customize this to show different holding periods, different tax rates, different growth rates. But essentially, it's here to demonstrate that you can either take the IRA in a lump sum, pay all your taxes now, or have the children take this over a period of 10 years, which would increase over time the total distributions to them. Alternatively, if you wanted to use the life insurance as that quote stretch device on the other side, we show how putting the life insurance inside of a trust, which in addition to the life insurance, you also have the remainder of that retained side fund. Now remember, we didn't spend all the RMDs on life insurance, just a piece of it. And the excess RMDs that were retained plus life insurance can be held inside of a trust and distributed, in this case, to the children. What we're showing here is distributing that over 34 years. So when you compound that over that long of a period of time, you're really showing almost a $5 million increase into what they otherwise would have had if they just took everything in a lump sum all at once. So these are options. Certainly, if the client stops and says, yes, let's do Q Plan Max and let the kids take it all at once, fine. But if the opportunity or the discussion comes up talking about having the ability to stretch, there's a couple of ways we could show that. Instead of leaving the annuity or the insurance to a trust to the children, it could have been grandchildren. We could have stretched that out. If the grandkids were 30 years, how about stretching that over 70 years? Imagine what the numbers could look like. So we can customize these presentations based on your specific client and what they're looking for. If it's just a standalone Q Plan Max, we have that. If it's Q Plan Max plus the stretch, we have that too. So, hopefully Ken can come up with a couple of more of these clients.
Actually, Joe, you worked with me on another case where the client said, could you illustrate for me, what does it look like if I, Roth the value of the IRAs over 5 years, or if I took the RMDs and bought life insurance. So that was another great option for the client to see. And again, that particular client probably had about $10 million in their IRA, plus about 13 million outside of their IRA. And they're, moving forward with being underwritten for life insurance as well, because again, the client and the advisor were convinced that buying the life insurance with the RMDs was more effective even than the Roth conversions as well. So that was another interesting opportunity.
Yeah, yeah. As part of our Q plan inventory, we do have what we'll call a Roth conversion analysis, which does compare the current plan, retain your IRA, convert to a Roth, and then we have choices on how you're going to handle the tax payment on that conversion as compared to leveraging the IRA with life insurance and just see where the numbers cross. And based upon a particular client's age, you're going to have different results. The Roth conversion, I don't know, Kim, I seem to hear about it more and more every time Washington talks about raising taxes. Roth conversion conversations come up. So I'm certainly starting to hear a little bit more about that now. So if you have.
Hey, Joe, a couple questions came in for both you and Kim as it relates to the initial questions, the first example that we were talking about. So the first question was, how old was the client in question?
It was 74, right, Kim?
Yeah, 74.
Okay. And then the next question was, can you explain the numbers in the chart? Current IRA value 6 million.
Okay, that's the previous slide. That's the current value of her IRA today. And then if you project out to age 91, given a growth rate and the RMDs, again, just taking RMDs plus the growth rate, by age 91, that IRA would be 5.6 million. Then we calculate income taxes, and then the RMDs that were taken are put into a side fund at a rate of return, and that goes up, grew to about 5.2. So when you add it all up, the net to heirs on a lump sum payout, let's call it, of everything would be somewhere around 5.
Thank you. And then another question came in, which was, if you have a 62-year-old that has some IRA money that he converted to a Roth in 2020, would it still look good to take the remaining IRA assets and project using future RMDs to buy life insurance?
It couldn't hurt to look at it. The older the client, as it relates to Roth conversions, the more difficult it is to show the Roth conversion as compared to buying life insurance because of the tax cost and the recovery time to offset that tax cost. If the client's younger, obviously, there's a little bit more time to recover that tax cost, so it may look a little better as compared to someone who's in their 60s or 70s. At least that's what I have found.
Well, and the other thing also is, the Roth conversion doesn't get the asset out of your estate. So.
No. There's always that estate planning aspect to it. So if the insurance is for estate liquidity or other estate planning, then whether or not you do the Roth conversion, both assets are going to stay in the estate in some form. So I guess it depends on on the reason that the life insurance is there. This, Kim, your case basically is really for legacy, so it's enhancing legacies. If it's for liquidity, then the need is still there, but we can look at it, sure.
Thank you. Those are all the questions that we had come in so far as it related to the examples that you were discussing.
Okay, if we move a couple of slides forward, we could bring back Carly because I know not everybody has a $6 million IRA. And there's a much broader market that we can look to and show some strategies. So Carly, I'll kick it back to you, and we can talk
Sure.
about what we call a Q plan backstop.
Yeah, of course. So, and one other comment too on Roths. So under the Secure Act with the 10-year rule, the Roths also need to be liquidated within the 10 years as well. So there's not going to be the same income tax hit on the Roth, but that's just something to note as well. So if you're looking to do a Roth conversion and then have that be a legacy vehicle, that might not always be getting you to the intended place that you want to get to. But as Joe mentioned, there are some broad market concerns that we find people have with retirement planning. So people come to us a lot of times, or advisors like yourselves come to us and say, my clients, they're approaching retirement age, thinking about all the different things that could go wrong in their retirement years. Do I have enough to support my lifestyle? That's kind of one of the first questions we ask. And I think, as we know too, that's very much an imperfect science in many cases to know, do you have enough to support you during your retirement years? But there's all these different risks that we factor in, and some of these risks are unknown risks. So things like longevity. Will I outlive my retirement plans? What happens if I live too long or if I die too soon? So if I'm working and if something were to happen to me during my working years before my retirement's fully funded, how would that impact my surviving spouse's retirement? The other side of that could be, certainly, if I outlive primary retirement assets, what does that look like in terms of the type of retirement I'm looking to have? Sequence of returns. We've talked about this a lot last year, in particular when we had the dip back last March. But if you retire during a down market, the sequence of returns is basically this theory that shows that it's virtually impossible to make up those losses in early retirement years. So could having a source of funds to take distributions during a down market help to alleviate some of those concerns? Medical expenses. This is another unknown retirement risk that many of us, we hope to not face, but the reality is that long-term care costs are rising, and it's something that affects many of us. Maybe some of us have experiences with long-term care. I think most of us probably do. I know I had similar experiences with my grandparents and seeing them go through that. So I think long-term care and the rising cost of long-term care is something that's particularly front of mind for people who are heading into those retirement years and thinking about that, and have more close personal experiences with those sorts of things. So that's a really kind of hot button item, I think, in a lot of these conversations. And then, of course, there's unplanned expenses that can come up. But then last but not least, taxes. We always talk about taxes as a retirement risk, but taxes are sort of, all these other things are unknowns. Taxes are unknown to the extent that we don't know exactly what taxes will be. But for our clients, paying taxes in retirement is unfortunately an inevitable for our clients. So thinking about the longevity of their plan due to income taxes and what does that look like, that kind of made us stop and think about how we typically approach what we call our retirement backstop design, and try to see, we talk about all the different ways the life insurance policy can help to protect clients during their retirement years. But how could we address this sort of known of taxes, and could it help to extend the longevity of things like qualified plans having the ability to tap into that money? So we know that people typically rely on two primary sources for retirement income. You have Social Security, that's going to be subject to income limits, and a percentage of that's going to be included in federal taxable income. And then we have qualified plans, which is what we've been focusing on today. So distributions subject to income taxes and require minimum distributions at age 72. So income taxes are a certainty. They will impact your retirement plans. We have tax law changes potentially on the not so distant horizon here, where we could see an increase in the top income tax rates, in the not, like I said, very soon, or possibly, or if not, by 2026. So income taxes are coming. Income taxes are going to be there. What can we do to protect against that risk? So that's where we really looked at the retirement backstop conversation and combining that. So the backstop conversation that Joe is really, and I'll let Joe comment on this because this is really, Joe is excellent at what he does, and he's very much one of our big ideas guys, as I always say, within advanced markets. So backstop really is one of his terms that he's coined. But I think, and Joe, you can comment on this, but a lot of times when we think about retirement and life insurance planning, we're thinking about money in, money out designs focused really on accumulation and trying to get the policy to build as much cash value as you can. Framing this as a protection conversation, though, really changes the conversation and makes this apply to, I think, a broader market, including an older age market as well. So looking at the qualified plan backstop is focusing in on one of these key risks, which is taxes and how does that impact your qualified plan. But looking at the backstop design from a protection design and looking at how does that impact retirement assets during that distribution phase is really important. So the crux of this story is really providing a source of income to offset and reduce income tax costs on qualified plans using life insurance. And then we'll see that it can provide a lot of different benefits as well too. So Joe, I don't know if you want to walk through the case study or if there's anything you want to add there.
No, I mean, the backstop, well, the qualified plan, backstop plan really is designed to ensure that qualified plan from the risks that are potentially going to occur during the distribution phase. And when we look at the broad market, where most people live, ages 45 to 60, they're still in the accumulation phase, but life circumstances have changed their view on how they are attacking the accumulation phase now that they're getting down to the home stretch heading towards retirement. As Carly mentioned, life experience, but you've seen parents, grandparents, friends, relatives, go through all those risks, live too long, die too soon, end up in nursing homes, run out of money. So there's a big concern now, especially during COVID, about long-term care and the impact that may have not only to yourself, but to your survivors, and what impact could it have on your retirement program. So this is best illustrated with basic case study. 50-year-old male looking to retire at 65, has a 401k of about 360,000, and is looking, they're going to still work and contribute, through age 65. And if we project out forward what the value of that IRA might be at age 65, we're looking at $1 million. For many people, that's it. I'm good. I'm gold. If we project what Social Security may be, maybe that'll generate $30,000 of income. However, this person feels that there is a need, especially now that they're in their peak earning years, that they need more than that. So they're looking at a potential income need of $80,000. So you have this 50-year-old who's hopefully in their peak earning years, who has the ability to set aside more dollars towards their retirement plan. So what we show is how we can use an accumulation IUL contract funded at about $2,100 a month for the next 15 years. Now, what that buys is about a $700,000 death benefit, which we place a long-term care rider on that could provide about $13,800 per month of long-term care. Now, our presentation shows what the impact of this planning, what it can do. So if we go to the next slide, we'll see that once this client hits age 65 and they do nothing, they would have at age 65 $1 million in their IRA, and they'll start pulling from their IRA the income they need to support their $80,000 lifestyle. And again, they're working off two buckets: Social Security, which could generate $30,000, and they pull $50,000 from the IRA. That's the 80. The IRA at 5% still has about $998,000. Everybody's happy until next April, when they fill out their tax return and they see they owe about $22,000 in taxes on the income that they reported at age 65. Well, since there's only 2 buckets to draw from, there's only one place to go for those taxes. That's the IRA. So at age 66, their income need is not only the $80,000, but also the tax bill. They're only going to get so much from Social Security. Where are they going to get the rest from? The IRA. So instead of taking 50, now they're taking 73,000. Well, what happens in a couple of years when they need a new roof or a new car or an unplanned medical expense? Once again, there's only so much they can get from Social Security, so the only place to draw on taxes and any of those unexpected expenses is the IRA. And what the chart shows is if this pattern continues, even if we assume a 5% growth factor on the IRA, by age 81, they've depleted that IRA. It's gone. So how could we implement, or how does this backstop plan ensure that we could extend the life of the IRA? On the next slide, what we show is by age 65, this life insurance policy has accumulated enough cash value that it, in a sense, has created this other, what I call discretionary, non-reportable bucket of money, a place where I can go, that third leg for the retirement stool, a place where this client can go to draw those additional dollars needed for taxes and or other expenses that may pop up. So as the chart shows, none of the numbers change in the first year, with the exception in year 2, instead of dipping into the IRA to make that $22,000 tax payment, I could dip into the life insurance policy to withdraw to pay those taxes. And what that obviously does is reduces the total reportable income from what would have been $123,000 down to $80,000. And what does that do? That reduces their tax bill in the future. So this Q plan, backstop plan, has the ability to implement not only a tax minimization strategy, where you can reduce the amount of reportable income by using life insurance as that non-reportable bucket, but it also provides the protection and preserves the value of the qualified plan. And the results are, as well, as you can see on the graphs, when you compare the tax payments, that delta between the current plan and the proposed plan really got big by implementing this backstop plan. And you see those 2 peaks in the current plan. That's those other expenses where they had to draw that $10,000 and $20,000. So by having this non-reportable discretionary bucket of money, drastically reduced the impact of taxes, which hence extended the life of the IRA, which we projected out would last to well past age 100. On the next slide, I think we show some more graphs just to illustrate the point that, you know, this qualified plan backstop plan accomplished 3 things. It reduced the amount of distributions required from the IRA, which hence extends the life. Reduced the income tax burden because the reportable income is much lower. And again, extended the life of the IRA. And if you look at the results at age 81 on the next slide, you'll see that there's still 830 some odd thousand in the IRA, and the life insurance policy still has a healthy $590,000 death benefit, which still includes that long-term care rider. Now, the chances are when you're 65, you're probably not going to need long-term care. But as you get older, obviously the odds become greater that you might. If you don't, there's still $428,000 of cash value. So again, that preserves and protects the longevity risk. And we show the reduction of taxes. So as you're going through your book of business, looking for clients who this may fit, it's really that broad market, that middle-aged client, 40 to 50, 55, 60, somewhere in that range. People who are entering their peak earning years and are really looking to allocate more money towards savings, that they currently have a qualified plan, 401k or pension plan, and they're just looking for additional ways that they can save for their retirement. And what we're able to show with these two ideas, the IRA legacy and this qualified plan backstop, is there's really no one in your practice that you should not be able to have one of these two discussions with. If you're managing people's assets and their IRAs and they're of this age, we could certainly put these presentations together for you to help you engage in that conversation. If you have clients who have healthy IRAs and are of age 65 and older and are looking to use that IRA as legacy, again, we have the presentations that can help you engage in that area also. So that's what we have. If there's anything, Caroline, you want to add, or Kathy or Gonzalo or anyone have questions, I guess we can open them up.
Yeah, I don't know that I have too much to add. I'll leave it and see if we have any questions, or Kathy, but I think, Joe, as you said, two different strategies, different types of clients, options, depending on what clients' goals are, but a lot of flexibility in how we design these. So
thank you. Yeah, a question did come in, and I encourage everybody to submit their questions. The first one that came in was, how are you illustrating the alternative use of the $2,100 monthly?
I'm not sure I understand what you mean. How are we illustrating it?
The questions, it came from Steve.
Hey, Kathy.
Yeah.
Kathy, let me jump in. Joe, I think what he means there, this is Gonzalo. You were illustrating a $2,100 premium at age 50 to 65.
$2,100 a month.
Right. So what if the client put that $2,100 a month in a different, maybe increased or maximized their 401k contribution? Maybe they put it in a non-qualified side fund, et cetera, et cetera. So the question, I think, is,
well, you're right.
is there a way to illustrate that?
He just qualified. He said, Gonzalo, you always read his mind. That's what Steve said. Investment into the life insurance versus other investment options.
Okay, great question. Love it. Do we have the ability to illustrate it? Yes. Does life insurance always win on a numbers format? Not always, probably. Sometimes. But what are the advantages or disadvantages of putting that $2,100 in a non-qualified fund? Okay, you have current taxation. You don't have long-term care. You don't have the death benefit to protect against premature death. I mentioned you don't have the long-term care benefit. You may have a few more dollars. If you draw on that $2,100 as that third leg, okay, part of that's going to be taxable if you think of realized capital gains. So even if it's close, what we could do is measure the difference between distributing those needed dollars from the non-qualified plan as compared to withdrawing those dollars from the non-qualified plan, keeping in mind the additional benefits that the life insurance policy can provide that the non-qualified plan cannot provide. I find if the numbers are close, life insurance doesn't have to be that much better, in my view. Sometimes it is. Sometimes it's not, depending on age. As long as the numbers are close, I think I could make an argument that the additional benefits that life insurance provides, given this idea, can more than offset the quote dollar advantage saving in a non-qualified plan can have. And again, that's not always the case, but I look at it from the worst case. If life insurance is close, here's the additional benefits. I hope that answers your question, but we can illustrate it to answer your question.
That I think that did it. I am not seeing any other questions, and we are at the top of the hour. So if we don't have any more questions, I am going to ask everyone. I know that we covered a lot of information, and as Joe said, if you've got, he listed a number of different categories for clients, and if you've got any clients that you'd like to discuss, please reach out to myself or to Gonzalo or to Ed Stark, and we will be happy to discuss them with you and get Joe or Carly on the phone and work on these cases with you. Kim, Carly, and Joe, thank you. That was terrific. Now what's next? As I mentioned in our May webinar, during the summer, we are going to hold these webinars once a month. Our next webinar is going to take place on Wednesday, July 21st at 4 o'clock. We are going to discuss how to help IRA beneficiaries optimize their IRA inheritances, how the Secure Act affects IRA legacies, and how to give IRA beneficiaries the advantages of a Roth conversion. So the Secure Act conversation continues. Our featured speaker will be Joe Ross, Vice President, Sales Productivity and Business Development from AIG Financial Distributors. Please mark your calendars. Since our next webinar is not until July 21st, I would like to wish everyone a great and hopefully mask-free summer and a terrific July 4th holiday. These are the closing announcements for today. If you have any questions or would like additional information, please reach out to me or Gonzalo or Dennis. Again, thank you to Joe, Carly, and Kim, and Wayne Baldwin from John Hancock for helping us put this presentation together. And thank you all for joining us. That concludes the presentation for today. Thank you.
Thanks, everybody.
Thanks, Agency One.